Welcome to Papaya Academy. My name is Sivan Fischel, VP Client Success at Papaya Global. Most people don't really think about payments until they really have to. They are owed money and they need it ASAP, or they need to pay someone. Today, I will take you through a course on payment basics. You will learn about basic concepts on cash flow, the system and interfaces that power payments, the typical payment process at a company, accounts reconciliation, how to optimize your payments, and also about regulatory considerations. Let's start with cash flow and fundamentals. Payments are the lifeblood of a business. If they stop, operations quickly grind to a halt. That's why a strong cash flow position balancing cash in and cash out is essential to keep your operations healthy and ready for growth. Most finance teams aim to bring money in as early as possible and hold on to it as long as they can. Their goal? To free up capital for investments that power your business. That might mean they set a 30-day term on their invoices to receive funds sooner or delay a non-urgent payment to a supplier. They need a good cash flow position with liquidity, enough money on hand to cover payroll or avoid taking out short-term loan. To manage this well, finance teams need clear payment schedules, reliable forecasts, and visibility into what's going out next. Payments don't happen in isolation. They depend on connected systems. Your accounting or ERP systems like NetSuite, SAP, or Xero are typically where invoices are approved, coded, and prepared for disbursement. Then payment instructions are exported, often as a batch file like an XML or CSV, and uploaded to your banking interface. This could be a bank portal, host-to-host connection, or an API integration. Once submitted, payments move through payment rails like ACH or SEPA in Europe to be issued from your bank. So now let's talk about how payments work at most businesses. Your accounts payable team plays a critical role in maintaining accuracy and compliance. They are your front-line defense. Typically, they receive an invoice for goods or a service, either direct from a vendor in your ERP system or manually from a team member. Then, they log this invoice in the account system, matching it to a purchase or work order, and review it for coding. Each invoice or expense is tagged with a general ledger code, and local tax rules are applied. Some taxes are reclaimable, while others aren't, depending on the expense type. In the UK, for example, value-added tax, or VAT, on client entertainment isn't recoverable, but VAT on office supplies is. Getting this right affects your tax reporting, how much taxes can be claimed, and ultimately your cash flow. Once your invoices are coded and approved, they're prepared for payment. In most systems, this involves generating a payment proposal, which creates a list of payables due based on terms and due dates. After review, a payment batch is created and pushed to the bank. Payment should always follow dual controls. One person initiates, another approves. Whether done through a banking portal or API-based automation, internal controls reduce the risk of fraud, misrouting, and duplicate payments. Audit logs and approval hierarchies aren't just best practice. They're required for compliance and good financial governance. Timing for payments is everything. The land date, when funds reach the recipient, matters so much more than the initiation date. Vendor contracts and payroll obligations specify the date or terms of when the payment needs to be received. This date is legally obligated. That's why it's critical to understand cutoff times for different payment rails. In the US, ACH can take 1 to 2 business days, where in Europe, SEPA usually lands the next day. Real-time payment networks, used in over 80 countries, process 24/7 instantly. Miss a bank cutoff, and your payment could be delayed, disrupting payroll or vendor relationships. For payroll, that's more than just inconvenient. It can become illegal and a reputational issue. Nobody wants Glassdoor reviews about late paychecks. And while vendors may not take legal action, their service quality could drop. Finance teams should track cutoffs and schedule payment batches accordingly, especially for high-stake runs like payroll or taxes. After the payment run, reconciliation begins. Payments are matched back to invoices, payroll records, and journal entries. Your bank feed should sync with your accounting system to mark items as cleared. But mismatches do happen, especially with cross-border payments and if remittance details are missing. The use of reference fields, invoice numbers, and structured remittance formats can help ease the matching process. Good reconciliation supports accurate cash forecasting, closes your books faster, and ensures audit readiness. Tools like auto-matching, bank rules, and exception workflows makes this whole process a lot easier. It's important to remember that payments are unfortunately a cost to your business. Bank fees, FX spreads, and people's time are added expenses. You can reduce these costs and optimize payments by using cheaper rails for routine payments, bundling international transfers, and automating high-volume runs. Payment calendars and cash visibility tools can help your business avoid shortfalls. Clear policies, data-driven decisions, and strong AP Treasury collaboration will help it all work. Lastly, it's crucial to keep in mind that payments are regulated. You must comply with local and international rules and establish oversight and strong operational controls. That's not optional. Non-compliance can mean blocked payments, fines, loss of banking access, or in serious cases, legal action against company directors. While banks handle many AML and KYC checks, you must avoid sending payments to sanctioned individuals or countries. Tools like OFAC checks, sanction screening, and beneficiary verifications are essential. For payroll, deduct taxes and file correctly. For vendors, collect required forms like W-8, W-9s, or VAT IDs. Skipping these steps isn't just risky, it can halt your payments and trigger severe penalties. So that concludes our course, Payment Basics. I hope you enjoyed it and now know more about the world of payments. Payments aren't just a back office task. They're a strategic function with a real financial impact.